Leverage, a tackle trading glossary video. Leverage, by definition, is also known as financial leverage. It refers to the use of debt, i.e. borrowed money, to acquire assets and increase the potential return of a specific investment. Leverage also refers to the amount of debt a company uses to finance asset purchasing programs. In trading, the most common usages of leverage are through a margin account, through options trading, through futures contracts, and through leveraged ETFs. Examples of leverage. In a margin account, you can access leverage by borrowing money from the broker. A margin account is an account which the broker essentially lends the customer cash to purchase securities. The amount of margin depends on the type of an account. A typical margin on a stock is going to be close to 2 to 1. So you would need to put up half of the money to purchase the security. In options, one options contract controls 100 shares of an underlying security. If you're the purchaser of a call option, you have the right to buy 100 shares of that security at a set price at or before a set date. Because the cost of the option is less than the cost of the stock, it's thought of as a leveraged instrument in trading. In futures, the margins are set by the exchange. They're relatively small compared to the cash value of the contracts. And in leveraged ETFs, these are securities that use financial derivatives and debt to amplify the returns of an underlying index. And they are also a leveraged product. These are four of the more common uses of leverage in the financial market, in the stock market. Another market of note that uses quite a bit of leverage is the Forex market as well. Thank you for joining us. Tackle Trading. Learn, trade, connect, succeed. Visit bit.ly/join-tackle-pro and get 15-day trial of our pro community for free so that you can try it out. TackleTrading.com.